Wall Street, a jungle of numbers, a casino of capital. It's where fortunes are made and lost with the click of a mouse. Every day, millions of shares change hands, each trade a tiny battle in a giant financial war. But forget the suits, forget the jargon, because the stock market is a real-life thriller, and anyone can play. It's about companies battling for dominance, investors betting on their future, and a global economy holding its breath. Think of it like a giant auction, where the goods up for grabs are tiny pieces of companies. Apple, Tesla, those mom-and-pop shops down the street. They're all here. And the price? It's not set in stone. It dances, it swings, it reacts to every whisper, every rumor, every bit of news that blasts across the trading screens. It's a wild ride, fueled by greed and fear, hope and despair. One day, a company discovers a gold mine, and its stock skyrockets. The next, a CEO gets caught with his hand in the cookie jar, and the stock plummets faster than a roller coaster. It's a high-stakes game of information, intuition, and plain old luck. And the best part? You don't need to be a Wall Street wizard to understand it. This is the stock market, raw and unfiltered. It's a world where numbers tell stories, where whispers can move mountains of money, and where the future is traded like a commodity. Buckle up. We're diving in. Let's start with the heart of it all. Company performance. Imagine a company's stock price as its report card, a reflection of its financial health. The numbers don't lie. Earnings, that's the profit a company makes after paying all its bills. Higher earnings usually make investors happy, sending the stock price up. Why? Because profits mean potential dividends, a share of the company's success paid directly to the stockholders. Then there's revenue, the total money a company brings in. Growing revenue suggests the company's products or services are in demand. Investors love growth. It smells like opportunity and future profits. But wait, there's more. Profit margin, that's the percentage of revenue that actually turns into profit. A healthy profit margin shows a company is running a tight ship, keeping costs low and efficiency high. Investors scrutinize these numbers like detectives searching for clues. They compare them to previous quarters, to competitors, to the overall industry. A company exceeding expectations, stock prices climb. A company falling behind, get ready for a slide. It's all about expectations versus reality in the stock market game. But here's the twist. Stock prices aren't just about cold, hard numbers. They're also swayed by something far less tangible, market sentiment. Picture it as the collective mood of the investors, a swirling vortex of emotions ranging from euphoric greed to gut-wrenching fear. When investors feel optimistic, confident about the future, the market enters a bull phase. Prices rise, sometimes defying gravity, as everyone rushes to buy. Conversely, when pessimism grips the market, when fear of recession or global instability sets in, the market turns bearish. Prices tumble like dominoes as investors dump stocks, trying to cut their losses and run for cover. News events, media reports, even analyst whispers can influence this fickle beast called market sentiment. A single tweet from a powerful figure, a groundbreaking technological discovery, or even a natural disaster on the other side of the world can send ripples through the market, shifting sentiment and swaying stock prices. It's a constant tug-of-war between fear and greed, with stock prices caught in the middle. Section 4. The economy's heavy hand. Now zoom out even further. The stock market doesn't exist in a vacuum. It's deeply intertwined with the global economy. When the economy is booming, unemployment is low, and consumers are spending, the stock market tends to reflect that optimism. Companies report strong earnings, investors feel confident, and stock prices climb. It's a virtuous cycle. But when the economic engine sputters, when interest rates rise, or inflation rears its ugly head, the market takes notice. Rising interest rates mean higher borrowing costs for companies, potentially squeezing their profits. Inflation eats away at consumer purchasing power, potentially impacting company revenues. Uncertainty creeps in, and the stock market, always a creature of anticipation, starts to price in the potential for an economic downturn. Government policies, trade agreements, even commodity prices, they all play a role in shaping the economic landscape, and the stock market reacts accordingly. It's a complex web of interconnected factors, with each economic indicator potentially sending shockwaves through the stock market. Section 5. Industry Face-Offs and Tech Tsunamis. Now let's narrow our focus to specific industries. Every industry has its own dynamics, its own set of competitors vying for market share. Technological advancements can disrupt entire industries, creating winners and losers overnight. Think of the rise of e-commerce and the impact on traditional retail giants. When one company innovates, others scramble to keep up, or they risk being left behind. The stock market is a ruthless judge of these industry battles, rewarding the innovators and punishing the laggards. Investors flock to companies at the forefront of technological advancements, driving up their stock prices, while those slow to adapt often see their valuations dwindle. Consider the automotive industry. The shift toward electric vehicles is shaking things up, with companies like Tesla surging ahead while traditional automakers play catch-up. Investors are betting on the future, and right now, that future looks electric. It's a constant game of adaptation, innovation, and competition, and the stock market rewards those who play it best.